Good morning, everybody. Good morning, Mark. How are you today? You okay?
Very well, thank you. Very
Good
well.
stuff. Good stuff. I'm looking forward to today's session. Definitely, we've got quite a lot of people in attendance, which is always very, very nice. As always, we'll hang around just for 30, 60 seconds just to let people get themselves in, get themselves sorted. I'm hoping you can all see my screen okay, and everything is nice and clear and visible in terms of visuals and how we both sound. Any problems, do let us know. Good morning to some, regulars that are attending our webinars and club lives all the time. So I appreciate those that keep coming back and keep coming back to see us. Good morning, Jade in the chat as well. So look, welcome to today's session. Please do say hello in the comments section so we know everybody is with us and everything is working. We do plan for today's session to run for the full hour, so an hour of CPD this morning. As always, if you've got any questions at any time, and I know some of these can get very interactive with loads of questions, now is your time. You are with Mark, the expert. So if you've got any questions that you'd like some answers to, please do not hesitate to pop them in two places. You've got the chat function, which you can see popping up now, or you've got a Q&A section if you'd like to keep things a little bit more anonymous. You are more than welcome to do so. I just want to make sure if you've got any questions that we can get them answered for you. We're big advocates of feedback. Feedback is so important to us. It's the only way we get to improve in how we deliver our content and how our collaborators present their content. So when you exit today's webinar, a feedback form will pop up. Please do take 2 minutes to share your thoughts on today's session. At the bottom of that feedback form, there will be a little section that says, do you require CPD? Let us know in that section if you'd like a CPD certificate for today, and we will get that over to you. If it's not today, it will be first thing Monday. So when you exit the webinar, the feedback form will pop up. All right, so please do leave us your thoughts. Getting straight into today, just briefly touching on the Financial Planning Club and who we are. Amanda Ford, myself, and Lewis are the co-founders. Amanda Ford comes from running two large AR national advice firms in the UK, one being an employed arm, the other being a self-employed arm for financial planners. Me and Lewis have spent over 10 years in the industry supporting firms with all things recruitment, culture, structure and organizational planning. So 10 years in recruitment. Jade is the backbone and the glue to our business. I can imagine so much stuff wouldn't get done if it wasn't for the incredible Jade Ling. Jade is with us in the chat function as well, and she'll be following up on any questions or comments as well. I've shared my QR code off of the back of every webinar that we run. I do create content. I do create newsletters. You do get to see and hear what else we've got coming up in the club as well. So do feel free to connect with me if you want to stay up to date with what is going on in the club and all things recruitment as well. So please do give us a little follow. That will be incredible. But look, seriously, we couldn't do what we do without the incredible support of every single one of our collaborators. Incredible firms just with incredible ideas and really just pushing the industry forward as a whole. The support of every single one of these firms are absolutely incredible. Not just the content that they deliver, but the support that they provide to our members, our club members, business owners, and the wider community as well. So thank you, and a big shout out to everybody that collaborates with the club. In relation to the wider community, so the club is a membership for owner managers that are looking to grow their business, but we do have a wider community for absolutely everybody, depending on the role that you play within your business, right? So we have 4 or 5 separate communities hosted on WhatsApp. So if you're a power planner, we've got a dedicated group for power planners. I think there's over 500, coming close to 600 power planners in a WhatsApp group. Same with whether you're an owner manager, financial advisor, ops manager, studying, whatever it may be, we've got a bespoke WhatsApp community for you. So again, on the feedback form, you can request to go into one of our communities, or Jade has kindly shared a link in the chat as well. Club Lives are our webinars, expert-led, practical, CPD accredited. So we're accredited by the LIBF to give structured CPD. So Always insightful, very knowledgeable, and it's a good place to come and get some questions answered. And the podcast is growing arms and legs. I think we must be up to about 60 or 70 episodes now. This is where you can hear the voices of owner managers of financial planning firms. All right. So the highs, the lows, the good, the bads, the uglies, and everything in between, and why they do what they do. It's a really, really good podcast to listen to. But also, likewise, if you've got a story that you'd like to tell, come on the podcast. It's a good place. It's a good platform if you've got something to say and you'd like to put your story out there, guys. So come along to the podcast as well. Next slide when it comes up. Just a couple of webinars that I want to touch on with what we've got coming up. New opportunities, smarter planning with bonds and trusts with LV. That's on Wednesday. So that's next Wednesday at 10 a.m. So how trusts and bonds work together, which clients may benefit most. Then we're with Aspen. This is going to be quite a cool webinar. Really looking forward to this. It's all about risk profiles. Are they still fit and fit for modern financial planning? It's been many, many years since the risk portfolios has had a bit of a shake-up, if you like. So this is how client expectations are shifting towards outcomes, the gap between risk scores and real financial goals. Then we're back with our friends over at Tatton, navigating the new world disorder. So that's at the end of June, Friday the 26th, 10 a.m., as it always is. It's really about how global trends are influencing inflation and growth. So some really good webinars. Again, all CPD accredited. So stay with us if you want some CPD. Today, we are with Morningstar Wealth. I'm delighted to be joined by Mark, who is a senior portfolio manager at Morningstar Wealth. Mark leads two of Morningstar Wealth's multi-asset MPS ranges and chairs the firm's UK Asset Allocation Committee. Over 20 years of experience in investment management, he's ideally placed to help us explore how advisors can navigate volatility and keep clients focused on their long-term goals. Mark, I hope that was on point. I hope that's your bio. If not, it's going to be incredibly awkward when you introduce yourself in a minute. As we know, we always ask questions when people sign up to our webinars. It's good to look back and see who's joined us today. What's interesting is that many attendees already know Morningstar Wealth, so that's really, really good. But they're clearly looking for practical ways to help clients navigate periods of market uncertainty, which is why we are all here today. The key themes coming through are around managing investors' behaviour, maintaining confidence during volatile markets, and ensuring portfolios remain aligned to long-term objectives. Mark, welcome. How are you finding things in general in the industry with volatility and client uncertainty? And how do you find, and I could imagine we're going to be covering this, but if you could sum it up in a short sentence, what would it look like from your standpoint?
Yeah, thanks. I mean, it's been a very interesting last 2, 3 years, and I would say climbing a wall of worry. We've been buffeted by several key market events, geopolitical events, yet markets keep rising and client portfolios growing. So it is around that stay the course that is the focus of today's presentation.
Absolutely. Absolutely. And we are pleased to say the last time Mark presenting this, he was a bit hot in a bit of a greenhouse environment. So we're going to create a bit of a better environment for Mark today. I'm going to stop sharing my screen. You can share yours and away we go. And as I said, if anybody's got any questions at any time, please do let us know in the comments.
Great, thank you. Yeah, as mentioned, I'm Mark Preskett, senior PM at Morningstar Wealth. 20 years in the industry, 15 at Morningstar, and focusing for the last few years on our MPS, and I manage our blended range and our international GBP range, which are two of our most successful ranges. What am I going to cover today? And it is really that sort of stay the course, keeping clients invested. We are experiencing difficult geopolitical times, yet markets keep rising, and the tendency of underlying investors is maybe to withdraw client money, pause saving plans in those periods of risk, and we're sort of trying to evidence why that's actually not the correct thing to do. I'm just trying to arm you with some help there as well. We'll touch on diversification, how we build our portfolios to withstand these. I mean, I think with multi-asset MPS, you can build portfolios that are a bit more resilient, and then actually, changing the narrative at the end on turning volatility into an opportunity, why you can actually make good money in drawdown periods. But so those are the learning objectives, which I won't go through, but they're there for you and the benefit of your for your CPD. So firstly, and the rump of the presentation is around keeping clients invested. I start with a slide that we put together, and it's borrowing some research from our friends over at Vanguard, who published a study trying to quantify advisors' alpha in the UK last year, and sort of put a number around the sort of various aspects of what you could do. And front and center was this idea of behavioral coaching, which was the main source of value add, especially when markets are volatile. And they sort of said up to 2%. And I thought that was quite a high number. It surprised a lot of advisors, but there is real veracity in that statement. And I think for us, the key aspect of that is managing in times of crisis. And we have been through a period of significant geopolitical change. We've had COVID sort of 5 years ago, then we had the Russian invasion of Ukraine, and more recently the US-Iran conflict, and sandwiched between that was Liberation Day. These are all in itself big geopolitical ructions that catalyzed some drawdowns in markets, some quite severe and significant drawdowns that spooked investors. And this is just honing in on the Liberation Day tariffs back in 2025, and looking at the performance of world equities through the year. And just very simply, what if you'd have pulled your money out when Donald Trump unleashed his board and catalyzed a very sharp drawdown in all stocks? And if you pulled out of the market, so this is £100,000, if you stayed invested, your return over the year was around 14%, a pretty nice return. Markets rebounded very well. Exiting the market, reinvesting 3 months later, you'd have made some money, but not much. And then obviously, if you'd have just pulled out and stayed in cash, that cash would have given you a return, but you'd have been money down. And it's those periods of volatility that 2% value add is most meaningful. And so we actually had a study independently of the Vanguard study. This is Morningstar. So Morningstar has a behavioral research department, and authored a piece of work called How Advisors Can Support Clients Through Market Volatility. And we have an advisory panel. Morningstar's behavioral research has an advisory panel of financial advisors all over the world, but mainly in the US, the UK, Australia, and South Africa. Actually, if you would like to be a member of the panel, there are some questions and surveys over the periods of the year. Not often, but it helps with this research. So please reach out afterwards if you'd like to be part of this advisory panel. But the study here is very relevant, and it was around, firstly, who reaches out during those periods. And it's quite interesting to see the breadth of client base. So newer and inexperienced clients, newer to investing, are the main one. The largest bulk of people with less experience in investing or new to the advisor's practice. We've also got clients near or in retirement, so they're relying on income, is another key group. But then also there's this sort of perennial worrier. overly cautious. And when I speak to advisors, often during those bouts of volatility, that an advisor will know who's going to call it, without question. And then there's other people that are more influenced about the media, etc. But it is a quite a broad church of
Mm.
all ages. It's not just necessarily the young, but people, older clients can invest, can get in touch, and clients are concerned about risk. But it is quite a lot of people, and I think what's interesting is to ask the next question. And I thought we would do a survey just to see what they're asking, what they're actually reaching out. So I believe that there's a poll. Is that?
Yep.
Yeah.
Yep. We're just going to fire off the first poll, which is going to be interesting to hear the audience's thoughts. When it comes to um, questions that clients typically ask, are they usually asking about the market themselves, or are they really being a bit more direct about their personal financial plan? Do you see a quite a difference between the two?
Well, hopefully this poll will shed some light, and I think I've got
Mm,
some information on that. But that is it. I think it's a bit of both.
mm.
Um, but let's not sort of
Preempt the answer.
lead the advisors into their answers,
Yeah.
but
But
we can see, yeah.
yeah, but also if there's something on, that's not on the list that you feel is quite important, then please do put it in the chat function because it'd be nice to hear. We was thinking about putting another on there, but another gives us nothing. So if there is something else that springs to mind, please put it in the chat function because we are keen to hear your thoughts on this. Um, how important is proactive communication before the volatility happens? I know you mentioned about most advisors can probably look at their client bank and they know when something happens. They probably know who the first handful of people are going to be that calls them. How important is it to be on the front foot on that? And
Yeah, and there is that sort of education piece and having collateral
mm,
at hand, um, or even before the event, to sort of help and guide and reassure clients that markets do rebound, that markets. So yeah, being prepared is also good. Having a bank of data is really useful. I think the
yeah,
poll has sort of come to a
yeah,
pause.
it certainly has. What do those results tell you? I'm going to share it with the audience as well that participated. Is that similar to the survey that was run internally?
Yeah, it is. It is quite resonating.
Mm,
And I think yeah, if you can see most of the clients, it's how are their investments are the most popular answers, how are their investments performing, or should they change their investments? There's a sort of an informational angle of why are markets falling, and just trying to understand that. So the headlines are always often quite sensationalist in most media publications. There's this idea about their financial security and lifestyle. Absolutely, that's another key aspect. People have their plans, their goals, their saving plans, and their lifestyle and then, will they rebound? And a smaller cohort, can they take advantage of that market volatility? And that kind of rhymes with so this is the results of our survey.
mm,
So number one, and this is percentage of advisors. So in our survey, they were allowed to choose more than one option. This poll was more just a one and done, but market dynamics and questions about the causes of volatility. So that market commentary still has a place, especially in and around market events. And I think it's, what we've learned at Morningstar is to increase the cadence of communication during those bouts of volatility. So on the one side, you could be sort of as an alarmist. We don't want to sort of create undue caution, but because of this, people want to know what's causing. We at least need to produce something to sort of explain what's happening. There's the classic one about, how are my portfolios doing? What's going on? That real time The lifestyle question is also very important, about how it's impacting their goals, making adjustments, what they believe in. And I think for us, the point of the one of the learnings that we would say is that very few speak about with a contrarian mindset. And
Mm,
so, in a way, an advisor can shift the narrative, to move it towards this idea that actually, it could be to think contrarian. Often, the best returns come during periods of volatility when markets, we see it time and time again. The narrative or the market communication really, punishes certain groupings of stocks,
mm,
certain, geographic regions, countries, and or indeed just equities more broadly. And that is actually an opportunity to increase savings or put money to work in markets. And it's a good antidote to that behavioral mistake, the biggest behavioral mistake, which is panic selling. So
yeah.
this is sort of where, how we would like, in a way, one way to nudge the narrative is to say, well, have you thought about, rather than assuaging their fears, but have you actually thought about putting some money to work? And, that's how we're thinking at Morningstar Wealth. And
How
so,
much, as I
go
say,
on.
how much does the client's attitude to risk reflect on this then? Because you'd like to think if somebody's attitude to risk was on the upper end of the scale, they'd be asking the questions around how can we take advantage of market volatility, right? And those that are, completely risk adverse, they're going to be the ones that are going to be saying, well, should we change what we're doing? Will they rebound? It's the output is going to, you'd like to think, mirror a client's ATR, right?
Yeah, absolutely. I think there is that aspect to it. But,
Mm,
from what we, when we look at the sort of the amount of capital in our portfolios, that the rump of clients are in that moderate balanced portfolio. There's, very, sort of 5-10% in the fringes. And it's that sort of key cohort of clients that are looking to still grow their capital, have a reasonable chunk of money invested in equities, say 60-70% in a typical balanced portfolio, maybe 50. And it's, what to do in those periods, and sort of just guiding them, nudging them to think about that risk. So we've put a few sort of, questions and advice, and some guidance through the. So firstly, when clients want to understand the markets, advisors can have that educational resources on hand to share with clients, to guide the conversation and aid comprehension. So those are sort of evergreen exhibits. You can update them regularly, and a lot of, DFM partners will help provide that educational resource. So that's almost an evergreen bank to help them, understand what's going on. And then when they want to understand what volatility means for their portfolios and lifestyles, I think it's, often good to show those graphs about how markets rebound,
mm,
specifically honing in on that. The markets in general, they typically rebound. We have drawdowns. They're coming more frequently, but markets continue to climb that wall of worry. You have recessions in, say, they're a common occurrence. Sort of 1 in 8 years, 1 in 10 years, we will get sort of a slowdown in the markets, but then how those markets rebound, and again, exhibits on hand that are there for you. For us, clients need to see the opportunity. So that contrarian mindset, that discount, if a client has brought up a certain investment in the past, maybe time to revisit them. So, this is, a harder a call, maybe more for those adventurous clients, but again, it's reframing the narrative to that contrarian mindset. And client markets do get oversold. The power of mean reversion in markets is very prevalent, and we continue to see, big discounts in certain groupings of assets that you could take advantage of. and then that reconnection with their long-term goals as well. So pushing past the volatility and focusing on those goals. So it might be a good time to revisit those goals if they are really nervous, remind them about the need to stay steady amid the market volatility. And so these are some of the recommendations from the study. And there's a fuller again, if you would like a copy of the study, happy to share that with you afterwards. And we've put together a few exhibits, two or three that might be useful for you. And this one we put together uh, this year, which just shows you that sort of long term picture. So we're going back to the late 19th century and just looking at US. Here is US equities and that the ructions that happen. So and the value of remaining invested. You can see the power of compounding despite these regular periods of drawdown that happen. And it's clear that that the lesson is markets always recover over time, despite we've had if you counted those, there was 19 major crashes over 150 years, and stock markets consistently rebound and go on to new highs. And you can't predict the recovery. And this is the dilemma. Even the most prescient or research heavy group can never really predict when markets recover. Sometimes it's quickly, like during COVID, actually it only took 4 months, despite arguably being probably the most serious of the ructions we've had over the last decade, whilst others take a lot longer. So the 2021 downturn took 18 months, and that's staying invested, thinking about the long term and that benefit of the long term growth. And what's interesting, and this is another exhibit that you may want to use or borrow, is that on the left we show the best days, the 10 best days in the markets. And what's interesting is that actually 8 of the 10 best days for US stocks have occurred within 2 weeks of the 10 worst days. So that volatility tends to cluster. And so withdrawing money on those worst days is often the error is augmented by the fact that the best days come quite quickly afterwards. And a lot of we have this exhibit. A lot of other investment managers will show this, but on the right is that sort of staying investor matters. If you take a 25-year horizon, have a 1 year initial investments over the last 20, if you miss just the one best day, the impact that has. If you miss the 5 best days and the 10 best days, so those are material differences in return. So you're almost half the the value add just from missing the 10 best days, and missing the one, you're still a decent chunk down. So I think this is another exhibit that you might want to use to help manage that sort of stay the course mentality. So that's the first section of the presentation around the idea of staying the course. And for us, as Morningstar, that's one of our key focuses is on producing quality collateral, and especially during those, there's a lot of us at Morningstar. We have some fantastic researchers and writers, and so how we do it is we produce dear client letters where it's written as though the advisor has written that letter, and then they can sort of just change the title too. And a lot of it's around that sort of navigating the path. So we'll produce any drawdown period, will produce a dear client letter to try and explain what's going on. And then just that general cadence. We've got messages from the CIO around what's going on, understanding the swings. And then we have our behavioral finance team periodically producing research like the study that I mentioned before. So, and I think it's important to have that sort of dissemination of material.
Mark,
So
how would people get access to those, mate?
So we have what we call our advisor hub. So it's a portal where we collate, or so it's where we collate our fact sheets, our performance progress reports, our annual, as well as all this collateral, these dear client letters, the CIO letters, the one-off quick response articles, and we'll collate that all into this. So you need a login. And if you reach out to us independently, we're happy to provide that for existing or prospective IFA partners. But it's there for everybody, and we're happy for people to use them, even if they haven't um, signed up to our portfolios or our platform, because we feel it's important to get the messages
Mm.
out. We're really proud of the research, and we think it's really high quality.
And how quick would you say after a bit of news or volatility would these dear clients' letters become available to advisors? If I mean, look, if I'm putting you on the spot and you don't know, that's
Yeah,
fine.
no,
But
I do. I mean, I help write a lot of so we look to publish them, 1, 2, 3 days afterwards. We're quite reactive, and we during the US invasion, we increased the cadence to weekly. We were sending out weekly missives. And then we'll slow back to sort of the regular monthly cadence, but we try to get something out pretty quickly. We've got a few researchers and authors, and so my CIO, Mike Coop, will write some stuff, and we'll depending on who's available. But yeah, we'll get stuff out as fast as we can.
and is this something that people can subscribe to be notified of what letters are available to them in this week or month or quarter?
Yes,
Yeah,
absolutely.
cool,
So once
cool.
you get onto the advisor hub, then you'll get notifications of the material that comes out. So as a lot of it is just standard market commentary through the
Yeah.
period. It's just during those periods where the main behavioral mistakes can happen.
Mm.
we get we've realized that that's where we call it a managed portfolio service, an MPS manager. We're there to manage money, but it's a service, and the service is that, those letters, and and we find our loyal advisors rely on that. They're really happy with the quality of it, and we take feedback all the time. Our MPS has grown quite significantly, so obviously our advisor partners are 100 200 300 fold now. So we're constantly getting feedback. We feel like we've honed our proposition, and pretty nicely, and we have authors on standby, PMs on standby when these periods happen.
It's great.
Thank you. Okay, so the second piece is just, and I think this is important, is building resilient portfolios. And ultimately, with an MPS, you are diversified. You can have different levers, different. So in an inflation scenario, you could inflation-linked bonds. An oil crisis, you've got energy equities, and it's that, and then this behavioral aspect that is important for portfolio management as well. So thinking long term, doing basing your decisions on research. And for us, we look for undervalued ideas. So our main basis of delivering alpha for clients is really during periods of stress, or even normal market periods. There's looking for those unloved opportunities to use in the portfolio. And it's all about breadth, so broad coverage, trying to get in as many of these uncorrelated ideas as you can. Um, rigorous research, really getting in to understand what we're buying, and that local specialist. So Morningstar does have is a global company. We have 900 researchers around the world covering funds, equities, sovereign bonds, credit, and and boots on the ground, that local expertise, being able to have a call with an analyst based in Seoul on Korean equities, or based in Australia, or on Australian REITs, etc. So and just trying to leverage that local global expertise. And I just thought, just to touch on how we're thinking about how we think about markets and what we're thinking right now. I think it's important. So we don't tend to try to focus on macro nudges to drive us. We use data a lot to drive risk taking, and so we aggregate on first on market valuations. That's our true north. We're valuation driven investors, and if we see that markets are frothy um, in aggregates, and so we're looking across bonds, equities, credit, government bonds, credit, small caps, large caps, private markets as well. And we sort of aggregate that into a heat map and really try to assess. And when we look at it today, we see markets are are sort of we'd sort of class it as an amber. It's not extremely expensive, but there's areas of the market that are starting to get expensive in our view. So credit markets spreads are incredibly tight. US equities look a little bit lofty in terms of valuations, especially in the last few months. And so, but in aggregate, we're not overly worried about market valuations. There's still pockets, areas that are okay. So the consumer stocks have been really hurt. We've got, property stocks are under love, healthcare. So it's quite a broad church, and that sort of holistic look at valuations is one key aspect. The second is investor sentiment, and that's just collating leverage in the market, the use of levered ETFs, for example, investor positioning. It goes beyond just a fund manager survey. We're trying to assess risk taking and confidence in the market. And again, we're starting to see a little bit of confidence, overconfidence bubbling away, especially around the AI trade. For example, today was launched in anticipation of the SpaceX IPO, a 3 times levered space exploration ETF. So you can see investor sentiment is looking to gear up, and behavior is starting to change a little bit. But again, it was actually a little bit worse in 2022. And so when we look at comparing today to 2022, if you remember, if you cast your mind back, that was the sort of the last big drawdown in tech. And we saw things like SPACs being launched and really quite frothy sentiment. So sentiment's another thing. And then the final piece is capital supply on what we're looking at. And I think this is the charts don't do it justice. There are just a lot of fuzzy lines, and I think our marketing team could do a little bit better on how to exhibit. But this has just come straight from our sort of one of our sort of packs. And what we're trying to do is assess IPOs, M&A, and debt issuance. So how easy is it for companies to issue debt, and at what terms? Where if there's a bout of M&A, what are the prices, the multiples that are being commanded, and then IPOs, what valuations are these IPOs coming at? And this has been an area where we've actually been relatively comfortable with until now. So if you think about it, firms are actually, if you look at share buybacks, is has dwarfed the de-equitization of markets. Companies have been very comfortable, earnings have been very strong, and companies have been very comfortable to buy back shares and reinvest in their own business. But M&A is pretty muted. IPOs has actually been pretty flat, cyclically low for the last 3 years. And this is why we're looking closely at the SpaceX IPO, the Anthropic IPO, the OpenAI IPO, and then whether that catalyzes more IPOs and at what terms. We've also seen Alphabet raising equity to buy other companies. We're getting quite technical, but this is a sea change in, whereas the Mag 7 were doing share buybacks, and they're now issuing debt to invest in AI data centers, and in Alphabet's actually issuing equity. And so that's our measures are backward looking, but that may change we feel that's a really important factor. Um, and again, in 2022 was the last time where we saw this flagging red, and it was actually a pretty good signal to de-risk. And the final piece is just around scenarios, thinking about the upside and the downside, really forcing our portfolio managers and analysts to think the bull and the bear case. And here we're just using the example of energy scenarios, and I think it's very easy to look at the worst case, but then forcing a bull case in times of risk, and then on when markets are going well, forcing people to look at the downside, what potential downside, what margin of safety you have in markets. So that's just how we're thinking about markets generally. The last, it moves us on to taking advantage of volatility and those opportunities that you can have. And the first example I give is just a simple rebalancing. And I think it's the power of rebalancing and why being contrarian can add value. So, and this is a real life example. So back in Liberation Day, it did cause a lot of panic in markets, and we saw equities fall rapidly and bonds rally. And so we prescribe to the idea of using rebalancing when the time is right, rather than following a calendar cadence. So most portfolios, they take a quarterly rebalancing cadence, and no matter what's happened in the quarter, we will rebalance back to target. That's a fine policy, and it, absolutely works. And I used to run models for years under that regime. But what we found is actually often you're just creating unnecessary turnover in normal market conditions, and it doesn't really do much. But then if you wait to periods where it can matter, you can see that the value adds. So in Liberation Day, we had one client of an IFA who was dead set on not rebalancing. So we took the decision, and this is when I say rebalancing, this is just buying back to target. So executing a program trade via the platforms, sell equities, buy bonds, in this case, back to our target weights. Often when markets are drawing down in very sharp manner, you don't really have, it's very difficult to start changing positioning without making a knee-jerk reaction. So the simplest is just to rebalance back to target. So we took the decision to, and one of our advisors delinked his client portfolio. And so the 1 year later, this is again not great marketing. I just pulled it from Morningstar Direct, but it's a 35 bip value add. Doesn't sound much, but that's from a client with £1 million in a SIP, that's sort of 3.5 grand. So it does, and that's just a simple program rebalance. And then obviously subsequent to that, we started shifting allocations. But this is just a very simple idea of why being contrarian works and how it can add value. Just that sort of buy and lean back into risk when markets are going down. And so in COVID, actually, we rebalanced twice back to target because the drawdowns were, but it did add value. So the first time, markets continued to fall, bonds continued to rally, but we rebalanced again, and ultimately, as markets recovered, we saw that value add. The second example I'd give is around sectors. It's quite we see big ructions more and more in certain sectors, and we think about the world in sector lens. And I think this is partly driven by the growth of ETFs and thematic ETFs, and the way that investors think beyond geography. I think 10 years ago, most MPS managers would think about their portfolio in regions, and we've shifted now to there's more homogeneity, more consistency in sectors. And with energy back in COVID, there was an opportunity to lean into that sector because it was at multi-decade lows. If you cast your mind back, we had the freedom of movement was prohibited. We had ports closed and oil tankers, hundreds of oil tankers sitting outside ports. unable to dock. We were also coming off the back of a major ESG trend where um, companies like BP were pivoting away from oil production towards a sort of net carbon neutral goal. I mean, the CEO is now no longer at the company, and they've completely reversed that tack. But at some one point, and oil price got negative. Energy equities, when we value them on a normalized basis, were as cheap as they'd ever been in our 55-year database. So our database goes back to the 1970s. So you were picking up the sector at the cheapest, and so we started buying and it's just leaning in and again we communicated that to our clients. It became our largest overweight to positions. We wrote notes to say why we're buying energy, and we continue to add. So if you remember during 2020 lockdown stocks rallied and energy leisure airlines all underperformed for quite a period of time, and we saw the rebound driven by the likes of Zoom, the Metas. People were sitting at home with their helicopter money buying stuff and not going on travel. But obviously the change occurred with the vaccine, and we saw this rapid the stock prices doubled. And very significant alpha for clients. And then once it reaches fair value, we just sell back to sort of neutral market weights. And so that's an example from the past on a sector. And actually, it can also add value at a country level. So, and this sort of touches a bit on AI, but is Korean equities. So, a country now that whose stock market has overtaken the FTSE in terms of market cap. It's now the fifth largest index in the ACWI. But when we were buying it back in 2024, this was a really unloved index. Political instability, a perennial discount because of corporate governance. But why we liked it was the access to two companies one called SK Hynix and one called Samsung. They are two of the three only approved by NVIDIA HBM memory chip makers. So a GPU or a TPU, these graphic process units that power the AI, the semiconductor AI data center, they need these high-end, high bandwidth memory chips. And there's three companies that make them: Micron, and it's listed in the US, SK Hynix, and Samsung in Korea. And there was a significant discount there. We were picking up those stocks at single-digit PEs. And then we had, if more historical of you may remember that Korea actually went through the president imposed martial law in Q4 2024. And it was swiftly ousted. He was impeached. He's actually now languishing in prison. The rule of law prevailed, but that provided us another opportunity to top up our exposure. And so we were buying back in periods, and since then the market is up sort of 220% and still going, and we've been subsequently selling. So it's for us, it's the way into the AI build out, in our views, has been and still is. Korea is a really neat way, and you're getting still, in our view, a discount relative to fair value of the stocks. So they've clearly, SK Hynix and Samsung have done fantastically well, but it just shows you how much alpha you can add from those valuation driven contrarian opportunities. And again, like with energy, we communicated to clients about what we were doing. I had one of our advisors based in Glasgow who said he wrote a note to his clients using our collateral about Korea, and he said, I felt like a Korean expert, but it being the key position, it being the major driver of returns. And for us, we're only looking for one or two of these names where we're happy to sort of add on weakness, and we can really add value to our clients. And so bringing it right back to that Vanguard study, they have a 0.45 a very low allocation to asset allocation. As you know, Vanguard, you know, huge supporters of their business. We own a lot of their tracker funds in our MPS. And I put money in personally into the life strategies for my wife back in the day. So got a lot of time for them, sort of market weighted, but their asset allocation is a low value add. It's an SAA with a sort of annual rebalancing program and very sort of market cap weighted emphasis. And we think when we look at our value add, we believe we can sort of triple that return when we look at our sort of longer term returns to augment that behavioral coaching. And for us, the key is that asset allocation and leaning into those contrarian opportunities. And a little bit of a plug to finish with before opening up to questions, if there are any, is we're winning awards for our portfolios. We're up for some more. Sorry, that's one of my PMs on the trading side. We're up for some more, and it's quite a lot of different portfolios up for. This is just showing our 60 multi-asset fund. This is our range. We have a wide range of portfolios. The most popular are our sort of passive and blended, but our active's also got some support. We've got an income. Blended and governed are roughly are mirrors of those portfolios. So blended sits between active and passive in terms of implementation, using predominantly passive, but some active managers to add value. We've got ranges for offshore clients, an ESG range, and a multi-asset fund. And then the last little plug is sort of our, total offering. So at its heart is our managed portfolios and funds, emphasizing our capital markets research. So we still sell our strategic long-term asset allocation. And we're updating that to True Potential. We've got an annual contract with True Potential to sell capital markets research, and long term we helped Tatton and 7IM in their early days build out their SAA capabilities. So it's a credible and then our managed portfolio has been running off it. We've got a platform, an advisor platform, which is proving sort of popular with a small cohort of advisors, and then we've got technologies that help advisors handle their complex data and processes, scale the business, Wealthcraft and Phenometrica. So we have our own risk profiling tool that sits within Wealthcraft. So that's all I had time for, as that's all I had prepared to talk about today. I hope it was of interest, and I'm happy to take any questions if you have before we close.
That was great, Mark. That was really, really good. Hopefully a little bit more relaxed than the last time you presented it. Anyway, which is a lot nicer. No, mate, really, really enjoyed that. And as Mark said, look, if anybody's got any questions at all, please do let us know. If not, you've managed to gain 6 or 7 minutes back before the hour, which is incredible. Just remember, when you do end today's webinar, please do give us your feedback. We'd love to pass your feedback on to Mark and the Morningstar Wealth team. So let us know your views and your thoughts. There will be a section on there where it'll ask you, do you want to hear from Mark and the team? And whatever that may be, whatever you're working on, whatever your thoughts are, let us know there, and we'll get the team to reach out and have a conversation with you. Thank you very much for joining one of the club lives, one of the club webinars today. I hope you all have an amazing weekend, and we go again next week. So any questions at all, please do let us know. If not, you are free to go on about your day.
Thank you.
Good stuff.